Are you ready to overcome the complexities and burdens that come with your success? Join the team at Centura Wealth Advisory in the Live Life Liberated podcast. Now, on to the show.
Hello and welcome to Live Life Liberated with the team from Centura Wealth Advisory. Derek Myron is on the podcast and he has brought on a special guest. Derek, why don't you introduce our guest today?
Mr. Mike Zelch, Chief Operations Officer at Actuarial Data Inc. Mike, welcome to the show.
Well, thanks for having me.
All right, Derek, you brought Mike on today. I'm here to learn from you as normal. What are you guys talking about today?
We're going to talk about qualified plans, and Mike Zelch is an expert about getting money into qualified plans and the best way to get money out of qualified plans. And so his business focuses on third-party actuarial services and estate planning, serving high net worth and ultra-high net worth individuals and families. Mike, can you take a little time and give us your background and education and the people you serve?
Certainly. I graduated college with a degree in mathematics, specializing in actuarial science. I cut my teeth in qualified plan world, working in Washington, D.C. at a large consulting firm, primarily on government contract work, dealing with PBGC projects like that take over some of the airline pension plans and the steelworker plans. From there, I kind of shifted it to large corporation and international pension plans, and at the same time, I kind of broadened my client work as well, delving into all aspects of employee benefits. After that, I worked for the Bank of New York Mellon to manage their internal retirement programs that had $6 or $7 billion in assets, and to help them develop some employee metrics. After about 5 years in the large bank environment, I moved back into consulting, where I had spent most of my career, to focus on qualified retirement plans, rather. And I joined Actuarial Data, where I am now COO. I made the move, I guess, for two reasons. One, my wife, also an actuary, had worked there for over a decade and had been conspiring with ADI's owner, Charlie Day, to bring me on board for some time. But the second reason, the real reason, is I was really intrigued and impressed with the strategy ADI had developed. We're not your run-of-the-mill TPA, just providing, off-the-shelf cash balance plan designs. We have a unique approach to qualified plan designs that typically can more than double the initial deductible contributions a plan sponsor can make. We have an IRS pre-approved plan document, like most TPAs, but our plan designs are usually specifically made to allow for accelerating or front-loading deductible contributions, so that a business owner can, fund to the IRS limits in about half the time it would take under the cash balance plan you get out of the corner cash balance store. Our designs also kind of focus on lifetime income for business owners and their spouses.
So, Mike, two comments. One, when I describe your services to our clients, I said, look, if you have a defined benefit plan, you want to supersize that. That's what Mike and his team does. They know how to supersize these deductions. That's one comment. Then second comment, when I talk to actuaries, I always say, there's no way you're going to go home and tell your wife that stuff. She's never going to listen to you. But it sounds like your wife will. She's an actuary as well.
Our poor children. Our bedroom talk is probably not standard, but yeah, we do a lot of pillow talk about things that people would not typically imagine. But we do to your point, we do take over a lot of plans. We get a lot of plans where the goals aren't being met, and we help a lot there as far as where else can we find deductions for them, or can we fund up this plan faster to meet the plan goals there?
Yeah, so to kind of describe the problem, oftentimes high income earners don't have the ability to save enough money pre-tax to really get them to their retirement goals. And when we find clients that meet that need, and they've got an off-the-shelf solution, whether it be from a custodian or their existing TPA, and we say, gosh, you're putting in $300,000 a year. How would you like to double or triple that? And they say, wait, I'm already doing the max. So that's how I describe your guys' services. Well, Mike's team knows how to supersize what you're currently doing.
That's exactly right, and you hit on something pretty important with a lot of these high net worth people. Our clients there are a lot of entrepreneurs, venture capitalists, and so forth. But there's usually a mad rush, at a certain age to start socking it away as fast as possible, and that's where we come into play.
Great. Thank you. That was very helpful. Let's turn our attention to discuss qualified plans, what the types of plans that meet the definition of qualified under the Internal Revenue Code. Why don't you answer that for us? What are qualified plans?
Sure. The short answer is, a qualified plan has preferential tax treatment. It's qualified by the IRS. The monies that you put into a plan that is qualified as a plan sponsor is tax deductible. There are you'll hear a lot of different kinds of qualified plans. They will have different marketing names and so forth, but essentially it boils down to two types of qualified plans: defined benefit plans and defined contribution plans. There's ESOPs out there, I think, as well, but I think you could do a podcast on that all by itself. But a defined contribution plan is generally account-based plans where the sponsor puts contributions into the participant account. Once the money is in participant accounts, the participant bears the investment risk. Generally, you can put money into a DC plan. It's limited by the IRS dollar limitation and by the participant compensation. So the current limit there is about $57,000, or is $57,000, and if they're old enough, catch-up contribution of $6,500. Defined benefit plans, on the other hand, are driven by a formula. The formula is what is defined and determines the benefit that is due to a participant. There are no individualized accounts, and the plan sponsor is responsible for paying a participant the accrued benefit at retirement based on the applicable formula. The plan sponsor bears all the investment risk for funding those benefits. But the real difference, I think, to point out here today is that defined benefit plans tend to allow much higher deductible contributions than defined contribution plans. Our plans, with our DB plans, you're typically going to see at least 10 times the allowable DC contribution going into our DB plans.
Fantastic.
To the accelerated, let's get the money in as fast as we can.
Yeah, our business owners are craving these deductions and looking for ways to do it. Here's a way to defer a bunch of money into a plan and defer that tax liability. So let's talk about the phases of qualified plans. And so the four phases, number one is this accumulation phase where you're accumulating a lot of assets. You then are in a retirement phase where you may or may not be have to take a distribution. And then there's this forced distribution phase. And it used to be 70 and a half, and perhaps with the defined benefit plan at 65 or 60. It just depends on the plan design. But that they're forced distributions. And then the fourth phase is the beneficiary distributions. At the end, you have a beneficiary on this plan, and you're going to pass it to a spouse or a non-spouse. You want to talk about the historical regime of how that's all worked, and then lead us up to the new change of the Secure Act and what's happened. Sure.
I think you kind of laid it out well for the life cycle of a plan. I think of the life cycle as, yes, the first part is the accumulation phase, and that is where the business owner is trying to build wealth and take advantage of the tax deductions, and that is one of the specialties of ADI, allowing for that fast and efficient means to get the money into the plan. The next phase in the life cycle, I guess, would be like you said, the retirement or the sale of the business or some qualifying event that leads up to the end of the contribution and accumulation phase. There, I would tell people the timing and the preparation of this phase is where I'd advise everyone to be sure they're getting quality consulting, working with their financial advisor, especially for a defined benefit plan or a sophisticated strategy like the ones Centura and ADI do. The decision when to stop contributing and terminating the plan directly can affect what you're going to be able to get out of the plan. And then the next phase, distribution. Yeah, you kind of nailed it there as well. At some point, the government wants you to take that money out of the qualified plan vehicle or vehicles. And why? So it can be taxed. That's the whole idea behind RMDs. The government is forcing the event to...
What is an RMD, Michael? Sorry to interrupt you. What is an RMD?
Certainly. That's a required minimum distribution. So RMDs used to be required at age 70 and a half. The Secure Act changed that age to 72, so thank goodness for small favors there. But the concept behind that is really you can't keep that money in that qualified plan forever. The Uncle Sam wants their fair share. With the Secure Act, it did several things besides change the RMD age. It also allowed for IRA contributions beyond 70 and a half, changed some rules for multiple employer plans. There was some very good liberalizing of the rules there. Changed the safe harbor rules for 401k plans. Interestingly, increased the credit for small employers starting up pension plans, and extended the deadline for adopting qualified plans. But I think the most relevant change that we could discuss is the removal of the stretch IRA. I think it was a huge blow to financial planners. You can certainly probably opine on that, where it propelled the need for alternative strategies to kind of to the forefront.
So just to define a stretch IRA, and this occurred December 20th in 2019, so just last year. But
right.
previously, oftentimes in the planning, generation, let's say dad, generation one, has a IRA, and he lists his spouse, and upon his passing, it can go to his spouse, and that's still the same. And then when his spouse passes, they have it go down to their 3 kids, and each of them could get it, and they take it out over their lifetime. And so you're stretching out, paying back, because all the money that comes out is taxable income to the beneficiary. The government decided that the retirement plans through the Secure Act were only to help G1, mom and dad, with retirement. Now that stretch is over. They're only going to give you mom and dad's life expectancy plus 10 years. So as soon as mom and dad are gone, those assets are all going to come out within the next 10 years, with the exception of there were 4 other small groups of beneficiaries. Children at the ages of 18 to 26, if they were still in college, then it had to come out after 10 years. Beneficiaries with disabilities, beneficiaries with chronic illnesses, and beneficiaries who aren't greater than 10 years younger than the account owner. So it's almost the same.
Almost the same, yeah.
Yeah. So other than those 4 special groups, everybody else, the retirement money is all going to come out within 10 years. Big change.
Huge. And I think that has led to a little bit of a revolution and resurgence in that old standby of doing the stretch IRA.
It's over, right? It's over for that. So with the stretch IRA being over, people need to rethink what they're going to do with this retirement asset. And if you happen to have a large enough estate where you're going to be estate taxed, the retirement accounts are going to be double taxed at your death or within 10 years of your death, because you're going to pay estate taxes and you're going to pay income taxes. The lion's share of people who are going to experience an estate tax and have retirement accounts are going to wind up finding out that qualified plans are terrible wealth transfer vehicles in 99% of most cases. What do you think about that, Mike?
I would largely agree with that. If the plan sponsor, if the clients don't have the right strategy in place, it could be a horrible transfer. There's a small, admittedly limited population where keeping money within a certain kind of qualified plan for like a family business keeps it out of the estate. In that case, we're looking at like where generation one is really accumulating the wealth, and they put it into the qualified plan, and they're essentially funding the retirements of their heirs.
Mike, let's just say that ADI has some special sauce for a limited group of folks that could really benefit from that special sauce. Is that a fair assessment?
It is. It's special. Our qualified plans like ours are inherently designed to maximize the wealth accumulation and stack up those tax deductions that like you can't find elsewhere. But keep in mind that, to your point, DB plans and qualified plans are centered around the accumulation. When we talked about that life cycle of qualified plans, they're centered around the accumulation and tax deduction. It takes additional steps and guidance to effectively transfer that wealth. So the other options need to be explored with that demise of the stretch RA. There's only a couple ways you can get money out of a qualified plan. The most common and probably the least desirable in this case is ordinary distributions. Where you just take the money that you're being forced to take. The problem there is that it could be limited, and it certainly will be taxable.
So, Mike, let's talk about quantify the problem for the listener. If you pass away with a retirement plan in your estate and you're subject to estate tax, your beneficiaries, if it's not going to your spouse, let's say both husband and wife have passed, your beneficiaries have the following math equation to calculate with their advisors. First option, we're going to just pay estate taxes and leave the money inside the qualified plan. So wait a minute, I'm going to pay 40% federal tax bracket. Let's say there's $1 million in there. I'm going to pay $400,000 on tax on a retirement account that's not all mine. And within 10 years, I have to take 100% of that out and pay income tax. Option 2 is I'm going to take all $1 million out of the qualified plan into what's called income with respect to a decedent for my parents in their final tax return, pay all the income tax, maybe that's 40%, and then pay 40% on what's left. What terrible outcomes. My parents would never have dreamed that they're going to lose 60 to 90% of these retirement accounts within 1 to 10 years of death. Terrible outcome for the family.
Agreed.
So with the passage of the Secure Act, I think that there are so many folks that are going to have to go back and take a look at their current plans to figure out what are we going to do. So, Mike, I know you were just about ready to go to the options. Why don't you go through what are the options that they can look at with their retirement plans?
So I think you covered the first most terrible one, Derek. The next option would really be a Roth conversion. Roths are incredibly powerful tools, and there's a lot of interest in Roths right now. So what is a Roth? I mean, basically, it is an account where you had already paid the taxes, so it grows tax-free. That's wonderful. You stretch Roths were an ideal idea. If you're going to do a Roth IRA conversion, you have to have the money to pay the taxes right now, and that's probably why there's so much interest in it right now. Right, we're at record low tax rates. So
to get out of you eliminate the income tax, but if you keep a Roth in your estate, you're still paying estate taxes on that. So you've only solved half of the problem there if you're able to convert the money from an IRA to a Roth.
That's right. So it's not it has
Silver
its
bullet.
problems. Leave it to you.
Yeah.
I'll leave it that way. It has its problems as well. There is also charitable distributions, qualified charitable distributions, if you meet the requirements there. I know some of our clients that definitely meets their needs and desires. So that's an option, but it also has its limitations. And then the final option, and this is where I see the result of the Secure Act. There's a need for something besides a stretch IRA, and there's been a new and refreshed, I guess, approach to a strategy that's been gaining a lot of momentum. And I really like this for a lot of our clients, who are not looking to maintain a DB plan for the long haul. It's pretty sophisticated, and it requires some quality guidance. But what it does is it effectively moves those qualified plan assets into a tax-free environment by sequentially taking advantage of rules and regulations that have been in place or are in place now. And then there is a fourth option. It's kind of a new and refreshed approach to some strategies that have been out there. Derek's team has such a strategy. It's called Derek.
We call it Qualified Plan Optimization Distribution, or QPODs, and that's the fourth option. And between the combination of the four, between ordinary distributions, Roth IRA conversions, qualified charitable distributions for those who qualify or have the motivation around that, and QPODs, all four of those can be used based on a client's facts, assumptions, and goals to determine how to optimize their situation. It's our opinion, for those folks who are likely going to be estate taxed, that Roth conversions are not a good strategy other than for the money that they're going to consume over their life expectancy. Any other money there, we think the combination of these other things can produce a much better result.
Again, that's why throughout this, I have to agree with you. You have to get the right guidance and the right timing down for getting this money out. It can add up to enormous missed opportunity if you don't have that guidance in place. And I would recommend having that guidance in place, or at least a roadmap laid out sooner rather than later. Ideally, you should have some mindset of that when you implement a plan, how you're going to get the money out. So I highly endorse not just looking at the current situation where you're getting the big tax deductions and you're accumulating. All too often I see our clients forgetting the aspect of, or needing to be reminded of the aspect of, hey, you have to keep in mind how you're going to get this money out. And it's best to start planning for that now.
The old adage is of not what you earn but what you keep is so true here. You can really accumulate the wealth, but then figuring out how to consume the wealth for yourself or pass it on to other generations. With the passage of the Secure Act in 2019, it has made this area of one's balance sheet much more difficult to manage. So highly recommend you get a plan. I think the last piece is there's been a lot of new thought around the beneficiary designations around these plans. Should I name my qualified charity to be my beneficiary? Make this be my charitable giving? Should I potentially set up a charitable remainder unitrust to be the recipient of my retirement plan upon my passing to try to stretch it out? There's other ideas around that as well. That's consuming a lot of my web time when I do searches on others. Do you have anything else that you want to share with the audience, Mike, before we go? And can you share with the audience how they can get in touch with you if they would like to contact you?
Certainly. I think we covered a lot. I certainly welcome any questions, and certainly, once again, advise, get these plans in place now, the full plan. All phases need to be considered when you're dealing with qualified plans. If anyone wants to reach out to me, they can always go to our website, which is Data Inc, ADATAINC.com, or email me directly at mzelch@adatainc.com.
Mike, thank you so much for being with us today. Eric, thank you for being with us today.
Absolutely. No, I enjoyed it. And there's a lot to consider, right? Anybody listening to this that's in that situation, obviously I encourage you to make the phone call. Derek and Mike, thank you so much for your time today.
Thank you.
Awesome, Eric. Thank you, Mike. Thank you, Eric. Have a great day.
Absolutely. And the last thank you always goes to you, the listening audience. Thank you for listening and tuning in to the Live Life Liberated podcast with the team from Centura Wealth Advisory. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when they come out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thank you so much for listening today. For everyone at Centura Wealth Advisory, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Live Life Liberated podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Centura Wealth Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Centura Wealth Advisory. Centura is an SEC registered investment advisor with its principal place of business in San Diego, California. Centura and its representatives are in compliance with the current registration and notice filing requirements imposed on SEC registered investment advisors, in which Centura maintains clients. Centura may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same results.